All right, so we're back here with Brian Dalton of Altius Minerals, and it was I think late last year that we released the introduction to the company, and I think quite a bit has happened since then. And I think the most interesting thing, which was quite recent now, is that Altius Renewables has been taken, or is going to be taken private. And I think to start off, first of all, it's a good premium for public equity holders. But I think, could you outline the rationale from Altius Minerals' point of view?
Yeah, the rationale for the transaction largely had to do with broader market sentiment towards the renewable sector over the past few years. When I look at, for example, the Canadian TSX Renewables Index, it's trading at about a third of the value that it was when we IPO'd the company in early 2021. And I think ARR has held up reasonably well within that. It certainly, looks like an outperformer on a relative basis, but on an absolute basis, when you factor in just liquidity and overall valuation relative to the growth that the business has experienced, we don't believe that the public markets right now offer the business an equity cost of capital that's accretive. So it raised money at the time of the IPO, equity obviously. Subsequent to that, the underlying joint venture, GBR, was able to raise meaningful amounts of debt capital, which was non-dilutive. But it's been a really successful period of deployment. I think the broader negative backdrop in the markets has actually been a boon on the other side, right? It's created lots of demand for our capital. But, on the flip of that, as we start to see the end of access to the debt, non-dilutive debt capital, and have to think about more equity to continue to grow the business going forward, it just didn't make any sense. In fact, it was at the point where we would probably have chosen not to make new investments if it meant having to dilute at the cost of capital that was being implied in the market. So that brought us to basically discussions with various strategic type investors, longer term pension type money. And through that, we were able to attract Northampton capital. We didn't actually intend for it to be a go private transaction. We were just looking for investors straight into ARR, but a lot of that pension type money doesn't typically hold pubcos. So that became kind of a condition to get access to that capital. And, what they're offering to the public shareholders is a reasonable premium to the IPO, and certainly relative to broader renewable sector performance. It was something we really felt that we had to bring to shareholders, and the reaction we've gotten from those shareholders has been fairly positive. So still a little bit of work to be done to see if the deal will close. I think it's scheduled for end of November, but it does seem to be on track. And I guess the go forward here is that Altius Renewables, through this transaction, will gain access to much deeper, longer term pools of capital with which it can continue to grow the business. And I'll point out lastly here that Altius Minerals, which is the current 58% shareholder of Altius Renewable Royalties, is not selling down in any way, shape, or form. In essence, what it is doing is it's trading the public markets and its public market shareholders for private capital as its partner going forward.
Yes, and I think I want to ask you how this impacts your capital allocation strategy in terms of the renewable segment. But first, can you just, for those who don't know, who are Northampton and what's the entity like? You say they have deep pockets. Could you outline what kind of a bit more in detail?
Well, Northampton Capital is basically a fund of sorts. So it's the principal, Jeff Strong, was formerly of Apollo. So what Northampton does really is aggregate pools of capital, and in their case, it's from pension funds, family offices, those sorts of things. So Northampton is obviously who's named on the deal, but I won't name any of them now. But the capital behind them, and that are ultimately becoming shareholders in this venture through their limited partnership structures would include some of the world's biggest pension funds.
Right. So does Northampton have other structures like this, or is this the only one as of now? What's the status?
Northampton is relatively newly formed, and as far as I'm aware, this will be their first venture, but certainly not their last. They have broader ambitions in infrastructure and energy transition type investments.
So
Real
essentially,
pension, real classic sort of long-term pension fund type investments. That's what they're focused on.
I see. Okay, so well, I think that's interesting. That clarifies something, and I think it also speaks to things not actually changing that much, I guess, in terms of your capacity to get more funds into Great Bay. But so at the end of October last year,
Some of it is bittersweet. It's not what we would have hoped for when we took the company public and we invited shareholders to come and join us on this venture. We would have, liked to have been able to continue that relationship very long term and to continue to grow the business with those shareholders. But sometimes you just got to roll with the punches. And when the cost of capital being offered to you in a particular market doesn't support accretive growth of your business, you're kind of in a spot. And that's what we found ourselves in. So in some ways it's disappointing to me because, again, we invited shareholders to join us on this. Now they're assuming the deal closes, they'll be exiting the investment, and I think in some of those investors' cases, probably a lot sooner than they would have hoped. Now, obviously, we have been able to offer them a premium exit, but yeah, and I think they really understood. Those we spoke with, though, that the long-term hopes we all have for the growth of this business are truly predicated on access to attractively priced capital. That's the other side of it. And if you don't have that, well, the thesis isn't working for anybody at that point. So such it is. Yeah. We roll with the punches. You let the markets tell you what you've got to do and you react to it. And in this case, we just had to go elsewhere to get the job done. And that's what we're doing.
Yeah, but last time we spoke, it's a delta about getting the capital at a certain cost and then what kind of returns you get by deploying that capital. And that's the arbitrage you're playing on. But what we saw last time...
Think about it this way. Think about looking at an investment today, of which obviously Great Bay is continuing to generate. And you think about what you're, on your own models and your own expectations and upsides and everything else, what the net asset value there is. And that's relatively straightforward. It's subjective, but it's a straightforward call, and it's kind of what we get paid to do. But on the other hand, we look at the assets that are currently in the business and what we think those are worth. So if we have to sell fractional interests in those existing assets at deep discounts, which is what we believe is implied here, what's the point? Like, why would you sell interest in what you already have at a discount just to raise capital to add new assets? Unless those come at, with such, unless you're buying those at an even greater discount, there's no accretion in it. You're better off just sitting and letting your current assets mature. So that wasn't particularly attractive to us, and we didn't think it was a very attractive proposition for our public shareholders.
No. So essentially, really what you're saying is that, we saw last October you got a hold of $250 million US essentially, and since then, yeah, to my understanding, you've deployed almost 100 million. So the rate at which you're deploying capital is very swift from that debt, but the debt capacity is reaching sort of its upper limits for the business size currently, which means that equity is the only means of acquiring new capital, and that's where you saw the issue in terms of valuation in the public market. Is that the same?
Yeah, we front end loaded the business with equity out of the gate and built up assets, yeah, and then we were able to leverage that with debt. But there's limits to that, and there's limits to how comfortable we are with that. And now it's the next capital injections here will have to be from the equity side of the ledger. The other way though is that you can just let the current portfolio mature, which was always another option. And as that matures, more equity will be built up, and that in turn creates more leverage capacity. But that's a slow kind of build game, and we really think that for Altius Renewables, the key strategy here is rapid scaling.
Right. So with this in mind, because last time we kind of established that yes, Altius Minerals will most probably be diluted down over time because it's growing. Renewables is growing faster than you can effectively capitalize through minerals. Is that
Correct.
how has the dynamic changed with the private partner now, instead of or consortium of private pension funds? I guess indirectly, does that dynamic change at all?
I think it's similar dynamic. Assuming that the deal flow is there, there's still going to be practical limits to how far Altius Minerals can fund, investments going forward. So, within this structure, in some ways, great success would be measured by Altius Minerals diluting on a percentage ownership, but growing on a total. Now, that's not at all to say Altius Minerals won't continue to invest and contribute, but it's really about keeping our portfolio balanced and what our own Altius Minerals limits are in terms of investing in the business. So, but this structure doesn't really change much there. I mean, it's the same dynamic, whether it's ARR raising money from the public markets. Well, it starts with GBR cash calling, right? We've got a deal. We're calling on shareholders to invest. Minerals or Altius Renewables takes that information and it decides, okay, well, it calls up Altius Minerals, decides, asks it if it wants to contribute, and then it thinks about its public markets access and basically comes up with what it needs that way. And now going forward, ARR basically GBR cash calls, ARR brings it to its two key shareholders, which is Northampton and its funds and Altius Minerals. And of course, if somebody doesn't contribute on a full pro rata basis to new capital calls, well, then they'd be diluted. But yeah, straightforward. No real change, I don't think, from a minerals perspective, except for the fact that the other investor in their ARR structure has deep resources, deep appetite to invest, and a very long-term horizon, which at least at present is quite a contrast with what the public markets have on offer.
Yeah, and then just comment on the trend of these last three larger investments. You have Apex Clean, US Distributed Solar, and Nova Clean Energy. These three larger investments that have been made in the last 12 months. Comment on the trend of the expected rates of returns and just your overall view on these investments.
I would say that when we IPO'd, we talked about sort of a returns band of 8 to 12, which is where we would have been targeting on an overall basis. And, the lower end of that would be kind of cash flowing immediate. The higher end would be where we're taking, getting involved with more development stage assets. I would say in both cases, that band has moved up a little bit in the market just because, well, a big difference back then is that debt was essentially free and equity was much, much cheaper. And all we're competing with those other forms of capital. So things have moved up a little bit, sort of on the first look base case basis. And I would say the other thing that I think has shifted there is our sense of what the longer term, returns might look like when you start to think about optionality and option value. Like just in the past 12 months alone, there's been an incredibly astounding shift in the outlook for demand for power in the markets that we're serving, right? And that's starting to show up if not in the current spot market prices, which are really kind of gas driven, in long-term customer driven power purchase agreements, you just see that price start to move up and up and up. So, because when we're talking about 8 to 10s, those are base case on what you see is what you get. But then when you start to think about these optionality elements, that's where, like in all royalty investing, that's where the real returns come from. It's never what the analyst says your return is on the first day that you're doing it for.
No, clearly. But if we just switch gears, I think let's talk about silicon. We've extensively interviewed Orogen lately, of course, where you're the single largest shareholder. that company, and that's also under scrutiny. It holds up extremely well. Probably one of the more excellent businesses in the sector, I would say, in my view at least.
They're doing such a great job. I mean, forget about the sort of the flashy headline items that everyone can see, but when I think about that business, I think about its execution as a project generator beyond like the flashy sort of silicon.
Like Larica, for example, is just getting an asset like that in that company is just tremendous. I think I'm really excited.
Yeah, look, they're just executing really well, and it should be no surprise to anyone that they're getting rewarded now because they've been at this for a long time, or at least through their predecessor companies. That some of those lottery tickets that you generate doing this business, some of them are going to come in. And they had great news this year on Ermitaño life extensions. It looks like with the drill bit, and obviously silicon. It's nearly impossible to get your arms around that thing. It's just, it's pretty crazy. So good on them. It's not luck. That's I think the point I'm making here. It's a product of really good execution of the project generator model. So total kudos to the team there.
Yeah, and kind of a tongue-in-cheek comment is I guess they would fit quite well within Altius 100% potentially as well. But if we just think about silicon, last time we spoke about silicon, it's I'm not going to put words into your mouth, but you were certainly leaning towards thinking about how this should be sold potentially. That was the discussion then. How has that evolved from Altius's point of view? What permutations can you see? Can you just outline your strategic thinking around the asset for you guys now?
I still have a hunch that the highest and best use for the asset, or where that asset is valued most strongly in the market, is if it's in a pure play precious metals royalty company. I still believe that it's actually one of those rare ones that comes along that has the potential to strengthen the multiples of the precious metals guys. Now, I don't know if much has changed in terms of our view of will that kind of evaluation for an asset like that ever be attained in a company that's not dominated by precious metals, because again, it's a different investor. It just really is, and we've never tried to cultivate for that. Now, look, I guess there could be arguments, and we've grappled with this, that if silicon gets big enough, maybe it drags the valuation of all of our other assets up, and we start to be seen as a precious metals company. But that's neither here nor there. And when I think about it more practically, there's no problem with Altius Minerals holding on to silicon as part of its portfolio. There really isn't, none whatsoever.
Totally agree.
You would have heard me say this before. Like, it has those key hallmarks that we look for technically in terms of long-term, optionality, almost certain to continue to replace and grow resources for, probably for generations in this case. So, the things that we just get really, really excited about. So there's no problem. There's no imperative to do anything here. And just holding it is not a bad outcome at all. So I guess, as in all things like this, it comes down to, are there players in the market right now who recognize something similar there and are willing to value and price not just what you see today, but the optionality that's quite obvious there. And if that's the case, thinking about valuations for top tier precious metals royalties, we might be inclined to a transaction, and particularly so if there was strong option value laden non-precious metal assets coming our way as part of the transaction. And I won't go deeper on that, but I mean, obviously we're quite on the record that that's something we'd be keen on. Well, I don't know how it's going to play. I don't know if we'll take proposals and we'll look at those, and if something looks really compelling in totality for our business and for our shareholders, we may do a transaction, and we may just look at it and say, there's no way this thing is worth so much more than this. This is a new, when we show that pie chart in all of our presentations around our commodity mix by or percentage by commodity, well, maybe gold is a big slug going forward. And that's great if it's based on gold on absolute spectacular asset.
Yeah, I mean, if we just look at Origin's market cap, I think it's just about 300 million Canadian right now, and obviously, I would say at least 80% of the value attributed to Origin by analysts is silicon or something like 70 or 80%. So it's being valued at sort of 200, just over 200 million Canadian. They're 1% NSR. So if you extrapolate that out, you should be at $250 million US in valuation for your exposure or something like this. And that gives a sense of valuation potentially.
Yeah.
But what does Brian?
Yeah, I mean, we can all do the math on what Origin's valuation implies here, and we probably all have different views on, netting out what Armentano is worth and cash and all that. But I don't say any of us are going to be very far off. The market is certainly speaking there. Yeah, you run scenarios for what the production rates might be and everything else, and it's not hard to get your head around that valuation, quite frankly, and more besides. But contrast that with, say, for example, I think the analyst consensus valuation for silicon within Altius today. So if we take what all the analysts have guessed it's worth, I think the average is somewhere around 150 million Canadian. So quite a delta there, right?
Yeah, it's a decent delta.
Yeah.
But I guess this is the same.
Fun.
Yeah. But it's, I mean, for you guys, it's less of a discussion, but I think it still is. The main thing with Origin, the precarious situation that they're in, if they sell this, they don't want to compete as a royalty company at all. That's not part, or at least currently, that's a difficult thing for them to embark on doing because they're a lot smaller. But for you guys still, it's a challenge to deploy if you get a lot of cash, that quantum of capital. And I would also presume that Altius shareholders want you to deploy capital and probably, hopefully, would not want a big dividend. I mean, that could be fine, but it's better if you deploy the capital. So it would seem to me that it would be quite attractive just to have the value trickle in over the years, where you can deploy the capital more accretively on a kind of a trading base instead of having a big check of cash coming in all at once.
Yeah, look, we think about that, and if we were to go the route of sale or partial sale, or if it's an asset swap or cash plus asset swaps, there's a million different scenarios. But if we're getting one great deployment opportunity, and again, I'm not trying to be too leading here, but it's just to remind you of what the messages we would have been giving late last year and early into this year, that buying back big chunks of our share capital and increasing every remaining share's percentage interest in the other assets that we hold, from CAMI to the Potash and all of the embedded optionality in there, that can get pretty exciting too. But it's market driven, and what's the market valuing assets at, and what's our view of the value versus the price. So don't ever worry that we won't find ways to accretively deploy capital without wading into some crazy M&A frenzy. There's always ways to do it.
No,
just gotta keep your brain open, right?
Not a concern for Altius. I guess we better start calling you Mr. Buybacks or something. But Brian,
think about it. What's the difference? What's the difference in buying some external assets than buying more interest? Essentially, buying up more interests in assets that we know so well, love, know what they're going to do for long. Like, what's the difference? Why does M&A? I think it's mostly because most businesses are driven around this idea of growth on an absolute basis. Right, it's about scaling up, and I think incentive compensation structures for managements and everything else, it's always external like that. But like, what's the difference of growing? I'd rather grow on a per share basis personally.
Okay, so that's silicon, but let's speak about Curipamba. It's transitioned into the builder here, the builder and runner of the mine, Silvercorp, and we actually just had an interview with Lon and heard about their plans. They're planning to release a kind of a solid update on the project, where they expect to see some capex reduction as well as improvement in metallurgy. Probably not on the copper side, mainly on the precious metal side, unfortunately for Altius, but still this is a project that's going to be built and it's going to be in production. Sounds like early 26 or sometime or latter half of 26. So your comments on this and yeah.
Well, first off, our interest there is actually an NSR royalty, so precious metals are part of the mix for us there. It's not
Right,
just a
my bad, my bad.
copper
Thought it
stream.
was copper.
No, I think it's great. The project is matched now well with a good mine builder, and probably most importantly with sufficient capital to get the job done. It certainly seems like it's turned a corner as far as permitting. There seems to be really good government and local level support. Probably local level support is one of the really unique features there, and I give full credit to the Adventus and Salazar teams in that regard, because they really took a patient approach, and I think have earned their social license. That's pretty obvious in the region. So yeah, no, I think we're looking forward to the Curipamba project being our next paying royalty. For us, going way back, one of the rationales around that acquisition. I'm not talking about the early support and sponsorship for Adventus, but after they latched onto that project, we went after a pre-existing royalty that was held by resource capital funds, and it came at a time when the 777 mine that we held a royalty on, was starting to see the end zone on that. So in some ways, that was laid in there as a bit of a replacement type bet, similar VMS type deposit, good precious metals credits. But I think it's obviously a really neat project given the extreme high grades and relatively modest capex. And I think beyond that, really the full potential of the region and the area that our royalty covers hasn't been much scratched yet. I mean, there's been so much focus on getting, true permitting and engineering and those sorts of things, but there's a lot of scope for that initial mine life that you're seeing at Curipamba, just continuously growing and expanding over time. And as you know, those are the kinds of things that we invest for.
Yeah, and that's clear in the big financing package that Wheaton has for property. It explicitly states that other VMS discoveries is also subject to their royalty, which is also telling, of course.
It would be incredibly unique in a typical volcanogenic massive sulfide district. It would be incredibly unique if it's a single deposit. That's just not normally how they occur geologically. It's typically clusters. There's often one real jewel within a VMS district, sometimes more than one. But it would be so unique if that's the only center that produced metalliferous massive sulfides there. But anyway, that's for down the road, and as focus shifts from development into operations, I'm sure that Silvercorp will turn its attention to allocating capital to extending that mine life and extend. It's just the way it works. So it's looking pretty good. I'll knock on some wood here.
And we saw the last reported quarter, that base metals and battery metals actually overtook potash in terms of royalty contribution. I don't know if that's the first quarter that has happened. I don't have all the numbers with me, but it might have been at least the first one in a while. So, and this is another asked
first one, probably first one since 777 wasn't the big. So 777 used to carry a lot of that weight, but it's a function of a few things. It's just obviously potash prices have slipped back a little bit, but it's within that potash seasonality, a lower quarter too. Yeah, that's why we have that diversified balanced portfolio, and it's something has an off quarter, and usually something else has an up one, and over time it. We don't look too much quarter to quarter. I'll be honest with you. We can stand back further than that and see.
Why not? We're familiar.
And I mean, especially too with the base metals and Chapada. there can be significant shifts quarter to quarter just on timing of sales. So, when copper hits a port and when the warrant is created, you can have twice the amount of copper subject to stream from one quarter to the next, but that doesn't mean there was twice that much copper produced that quarter. It's just a little bit of adjustment. So,
And just briefly before we leave Curipamba, for those who don't know, what's the expected royalty contribution? Kind of just a range once it's in production, because that's going to be one of the next ones actually coming into cash flow for you guys in the portfolio.
I haven't looked at that real closely lately, but at current prices, I'd be surprised if you're not looking in the sort of $5 million US kind of range for us. Maybe even a little more, depending. Well, I mean, it's hard to keep up with the gold price adjustments. The last time I probably would have run those numbers, I was probably running $1,500 gold, right? So,
yeah.
It'd be interesting actually to look at, because over time we've seen like the contribution to the overall royalty from precious metals versus base metals, the relative percentages shift. Don't hold me to this, but I'll get someone to have a look at it on our team. I wouldn't be surprised if it's not more of a precious metals based NSR at the moment on a spot basis.
I mean, not for Silvercorp, but on an asset basis.
Maybe we are becoming a gold royalty company and we just don't know it.
Yeah, and the question is it even worthwhile trying to fight that inevitability at this point?
We don't fight anything. We roll with what we're given.
So you're going to acquire a big portfolio of assets and lose your way. I don't know. So this is maybe not top of mind for you guys now. It was discussed earlier this year, but we have not discussed it on our platform. So let's speak about Kami. The FS was released quite shortly after our last interview. So let's talk about that. Where you think Champion is currently with, because this is the next project. If they're going to build something new, it's Kami, right? So talk about the position currently, what your thoughts are on.
Well, I guess a few of the developments that have happened since we would have spoken. Obviously, the feasibility study result came out, and I would say that in the market it looked like a bit of a yawn, in that when you plug in iron ore prices that are based upon a sort of benchmark 62 and lower grades of iron ore, the economics looked okay, but not screaming. We obviously have a different view about where that product that Kami can produce, which will be an ultra high purity product, will ultimately price. And Champion has been fairly clear along the way, and certainly this hasn't shifted or changed, that they believe that there are end users, people that are building electric arc furnaces that need that particular product, that also are willing to take that view just to secure supply and to provide financing for the project. So I think that's still probably the single biggest catalyst that we're looking for, and that our shareholders should probably be looking for. They don't expect some kind of market-based financing out of Champion to build Kami. You'll know this is happening when you hear that they've probably signed a deal with some end-user steel company in some form of partnership or offtake structure, and then you'll know the project is funded. But the other thing that has to happen before that is, because the project scope changed from the time that Champion acquired it from the previous owner, so they're obviously trying to produce a much higher quality product. The production rates are different. It meant that the permitting process had to restart. Now, obviously, you can build on the former permits that were granted for the project. So that kicked off earlier this year, and I think the guidance is for that to be around, somewhere late next year, early the year after kind of timeline. So that's ongoing. And then thirdly, high purity iron ore was named by the Canadian government as a strategic mineral since the time of the feasibility study result. And that has all kinds of implications for tax treatment, various cost of capital elements, broader government infrastructure support, and those sorts of things. So it's my understanding that there's quite a lot of discussion underway. So a lot of these things are all happening concurrently. There's partner discussions, the permitting process, and then you know, the business case as it might relate to tax and maybe some types of other supports. All these things are happening concurrently, but I still get the sense that Champion is quite enthusiastic about the project, and that the broader market of end users is quite excited about finding a way to get access to the product that it can produce. So it'll take some time, but it's all going the way we hope here. Champion does not. Champion is not known for overpromise and underdeliver. They're quite the opposite in that regard. So.
Yeah. So just to clarify, you think there's a possibility that a financing package could be put into place prior to them receiving the amended permit? Potentially.
Well, those things are all happening concurrently, and I can't imagine that even if there's a partnership or financing package that's announced in advance, it wouldn't have as a some type of contingent commitment, that permitting, those sorts of things. But yeah, I know that these things are all happening in parallel, and of course, like especially those discussions with government will have implications back to the financial model and to the partnering discussions and those negotiations and those kinds of things. Well, again, as far as I'll go with that is just repeat what I've heard, in that demand from potential end users to participate in the project remains quite robust. So that market looks very active and hungry, probably a little bit in contrast to the spot market for 62% iron ore and what you'd read on headlines up until a day or two ago anyway.
But you would expect then sort of an offtake with some kind of financing package from industry partners, as well as potentially some government more significant support, because this is
that really seems to be what Champion is communicating, that their strategy is that the Kami project permitted would proceed under some type of partnership financing structure, i.e. they're not targeting, for example, the equities markets as a source of capital to build a mine. That maybe is the strongest part of that message.
And I think if you look at their enterprise value, it's just short of 4 billion Canadian or something like this, and their debt is like 500 million Canadian or something like that. Net debt is a couple of 100 million. So they can certainly access more debt on an asset level, but also on a corporate level. So it seems like that's good, and they're making pretty good cash, like just about 100 million, I think, in net income last quarter. So yeah, it's a strong business.
Yeah. Well, the other thing about it is that they are finishing up the upgrades at the adjacent mine, their existing mine at Bloom Lake, to start to produce that higher grade product, same type of product that Kami is targeting. And so that creates an opportunity for a fair bit of market discovery for what that differentiated product would sell for, relative to anything that you're seeing in the quoted markets right now. So, that's part and parcel of the process too.
Sure. And then next up, I guess, is the good old Voisey's Bay, dear and near to your heart, I guess. And we spoke with another royalty company, Ecora, that also has royalty on the asking, got a bit of an update on the underground Rampup. But why don't you give your comments on the Rampup underground specifically, and your expectations in the next sort of year, where they will be at?
Yeah, so we obviously keep our ear to the ground there, almost more out of we're in the same community we live in the province where the mine operates, and so it's not that unusual. I mean, these types of ramps ups, you're going to encounter some surprises, but I don't think anything really dramatic needs to be thought through there. The east, so Reed Brook is now operating and starting to come into its own, and there is a good timeline here to see Eastern Deeps brought into production. I mean, they're down at the ore levels now, so things are coming along. Yeah, I mean, I think to me, it's just it's a big, complex project. It was a big undertaking, and I don't see how 6 months, one way or the other, in what I believe will be a 50-year mine life, really is going to matter one little bit. So all good.
Yeah, yeah, okay. Very Brian-esque of you. But I guess
Yeah, well, what's
in
the point
six.
of worrying about that stuff? Like, who cares, right? It really doesn't
Yeah,
matter.
I
What I'm more
guess
excited about is when they publish these maps and they're showing, there's the bottom of the mine plan right now, and then they're publishing these drill holes that just go and go and go and go. Like,
that's the man.
that's where it gets exciting for me. It's after all of the focus comes off of just getting the mine built, like getting these operations running, and you're on a constrained remote site. So all the workers there are focused on that construction and everything else. Move it to normal operations and crystal ball it out 5 or 10 years when they've drilled off all of these things that they're hitting, and everyone will realize that this thing will not be closing in 2034 like the current mine plan says. I don't know if it'll be hitting its stride by 2034, quite frankly.
So for all the myopiacs out there, I'll try to force you to give some context on the next 12 months or something like this. But what do you think in terms of royalty contribution to you guys? What step up will you expect to see as underground comes into? It won't be fully ramped up, obviously, but it will be a good way there, I would expect, by sort of this time next year. How do you think that
I don't
impacts your?
really have, I don't have it like a model number I'll spit out at you here, but for the next little bit until this thing ramps up, you're probably talking in the 1 million, 2 million kind of range.
Okay, all right. Well, that's good. I mean, it's on track. Another good contribution for you guys. And I just want to do kind of a couple of brief check-ins here. So just the Potash group of assets. Could you just give the status there and just general market comments as well about the Potash? What are your thoughts currently?
Like it feels like it's come back to a period of or a state of kind of normalcy in some ways after a pretty crazy 4 or 5 years here, with starting with the sanctions in Belarus and then obviously the Ukraine war, price shooting up and really starting to impact farmer economics and affordability, and then lack of application then starting to flow into decreasing farm yield. So it seems like you're back in that place now where farmers are getting a price that they can work with. They're applying at normal levels. Volumes have bounced back up to long-term trend line growth levels. Yeah, so it's obviously it's been a very volatile period. I would argue here that the current price is unsustainably low. Like the current operations are making a margin at these prices. There's no doubt about it. But like, there's no way that the supply demand deficits that are actually not that far out get addressed at these kinds of potash prices. You don't get, with the exception of what BHP is doing with Jansen, which quite frankly on its face does not look like an economic investment in any way, shape, or form if you're using anything like current consensus price tags. But to me, I've always looked at that as that was a very strategic decision for BHP. It was never about we spend this amount of money and we generate this amount of return from that particular phase of development. All they were ever doing there was buying an entry into that market and creating a physical platform for future expansions down the road as market demand grows. So, I mean, I wish I had something more exciting to say, but it's actually probably the most stable and normal potash has felt in about 5 years for me. I suspect right now you're dealing with a little bit of an over correction as far as price goes, and even that will, that'll all sort itself out. I think we're a little below trend, but we're doing fine. And I look back now, this is the 10-year anniversary since we made the original acquisition, and production volumes across that portfolio since we made the acquisition have almost doubled, right? Slowly, steadily, no fanfare, no splash. And that's all you hear from the guys when you talk to them now is, next phase is, we're going to add another 1 million tons here. We'll add another 1 million tons here. None of this big splashy stuff. And I have no doubt that in 10 years, we'll look back and the volumes will be that much higher again. And then at some point, there is going to be a big sustainable kind of price response here it's going to have to happen, actually, that triggers much bigger capex, but we're not seeing that right now. And it's probably setting up, but towards few years out towards the end of the decade, it's probably setting up another 06, 07 type real kind of real supply rationing type of crisis. That's not unique to potash right now, but it's all good. It's all good.
Yeah, I mean, if you see companies like BHP positioning themselves like that, it's very telling. They know what they're doing in that regard. And then I want to ask you: do you happen to know, off the cuff, 10-year anniversary, how much cash flow has these assets generate for Altius across this decade, and what was the initial investment? Maybe you have a sense of it. It would be interesting just to hear sort of reflection.
I would actually send someone a note to update me on this just a few days ago, because I'm pretty sure we're at the point now where we're crossing over passing simple payback over the original acquisition, if we haven't just recently. So that would be in the 200 million-ish kind of range here now. So all right. Look for that in our next quarterly update. We will be updating sort of where we sit to with all of the investments we've made up to now, and what's been returned relative to cash flow, and what sort of the remaining life looks like. But yeah.
And just one question, I guess. What's the stance from your operators? How are they communicating? Because they've been going back and forth with capital projects, as I've tracked them now and then. What's the current communication like?
I mean, I think you can see how it's all playing out now. When prices shot up, Mosaic flexed, and they opened up some of their higher cost production. And as they've depressed, they've shut that back in, and everything's focused now on Esterhazy. And that continues the debottleneck, and they're just adding, steadily more and more tons. So you can absolutely see that the Esterhazy asset, which we have the royalty on, is the core of their potash operations, and they're steadily, just adding volume, mostly now through sort of just cleaning up from that big push and that big capital spending program, and they're just finding ways to optimize. At Nutrien, it's the same sort of thing. There's continuing investment, but it's not sexy sorts of stuff. It's automation programs and things like that. But they all are adding up, and they're adding, they're helping with costs on one side, but they're also causing incremental, if not production, at least activation of incremental production capacity. But probably what I've liked hearing from those guys mostly recently is that they seem, as a company, to have really retrenched somewhat back to basics, less focus on downstreaming and retail operations and those kinds of things, to a core focus on where their real core strategic assets are. And in that, they'll specifically mention these potash mines are our strategic core differentiator. And so it's just nice to hear that, right? Just relatively new management. There's been some management changes, and whenever you hear the word retrenchment, you can usually be, if you're part of that overall system, you're going to be worried that that has negative implications for you. But for us, it was a breath of fresh air, because it just means focus and retrenchment to the assets that we not just have royalty exposure to, but we're the actual underlying owners of the assets. So,
Yeah. And then briefly, I would expect there's not too much to say here, but do you have any comments about Chapada as well? Just general performance and expectations. How is Sauva developing as a narrative, by the way? I mean, since last we spoke.
We continue to hear really good things about the Sauva resource, that there's some, we hear that beneath the surface mineralization that was discovered last year, and that the resource was published around, I think there seems to be indications that there's some real nice high-grade material beneath that. Now, I don't know if that means that would be something that would get contemplated as underground down the road or not. But there's been a lot of work at the Chapada operation itself in terms of just how they're managing the mine plan. I know they've definitely been dealing with, just climate events that have really been causing them to have to change how they think about the mine plan. There's water issues in the spring. Like when they happen 3 years in a row, you can't really call them once in 100-year events anymore. So I think that, there's that kind of work that's happening. We haven't had an update in a while on where overall expansion plans, are landing or falling. Probably some of that has to do, actually not probably, so almost certainly some of that has to do with that the Lundin Group itself is extremely focused on Argentina right now. So I don't know. I know there's good work going on at Chapada. It's busy. There's data being collected. There's studies being done. But in terms of what's being broadcast from the company, it's definitely been a quiet period there with a lot of the focus in Argentina. But yeah, everything we hear is that the thesis holds that there's a lot more resource that will be mined than we originally envisioned when we acquired it. There's very likely to be a higher production rate there, and yeah, so nothing real exciting to update, but steady progress. We still think it's a bigger operation 5 years from now than it is today.
Yeah. So if I ask you kind of an open-ended one then, so other than the sort of the main piece on the chessboard that we have discussed now, what would you mention from the portfolio that you would like to highlight for investors that has happened in the last sort of 12 months or since last we spoke, I guess, 10 months?
Well, I think we've gone around the board here now between iron ore, potash, and the base and battery metals, and the iron ore. But one thing we didn't really touch on is when we talked about renewables, we talked about the transaction, but that portfolio of assets. So forget about what might be acquired and getting attractively priced capital and everything else. There is a really neat ramp up of production and cash flows coming from that portfolio. There's been some delays around within the portfolio, mainly due to interconnection issues in the US and those sorts of things. But these are all still progressing with incredibly strong counterparties, and I would definitely say there's underappreciation of the kinds of attributable royalty revenue that are headed our way from that part of our business, and it's not speculative. You can go and visit these sites being built.
So put it this way: when do you think that the renewable segment overtakes potentially as the dominant or the largest segment in the portfolio? What's the intersection point you think in time on that?
Becomes the biggest part of the portfolio. That's still a few years away, and it presumes we're not balancing other parts of the portfolio concurrently. But I like renewables kind of in its, when I think about it on a NAV basis, which is a better kind of forecaster of where things will be cash flow in 5 years than today would be. I like it at the kind of weighting that it's at right now in our business. I think it's a nice complement to the other core pieces. But no, there's multiples of what you see today as royalty revenue, attributable royalty revenue from the renewables, without lifting a finger, without investing another cent. It's the path to that becoming several multiples of what it is right now is already in motion.
So if we just give people some ballpark data points, according to Altius, as a percentage of your NAV, I guess roughly, what will renewables be, and what's the current sort of annual, or what was the last quarter's royalty revenue approximately, or you can do any number you like to give a snapshot in time, and what do you think it will be in end of next year or in 2 years? Anything you would be, just to give people a sense.
On a NAV basis, well, I guess in terms of like the go private transaction, what market cap is implied there, we're arguing that the reason for doing it is that the market value undervalues the what we believe is the intrinsic value. We don't typically publish our own internal NAV estimates because it's kind of some of the secret sauce when we do buybacks and those kinds of things. But suffice it to say that the market cap implied through ARR would be less than we believe the intrinsic value is, and the fully option value, realized value looks like. So I won't go deeper on that. As far as revenue goes from within that business, so if I could drill down to the GBR joint venture, that thing is producing somewhere in the order, like it's deployed somewhere around 500 million US right now. And if you just take round numbers for the period when most of that investment was done, say 8 to 12, take 10 for round numbers, that implies that when all that investment matures, there should be somewhere in the 50 million US kind of revenue contribution. Now that's really back of the envelope numbers. So half of that back to ARR, and that will be against, so 25 million US against whatever it was last quarter, a few million. So there's a lot on the come there.
Exactly, and you guys would have 14 or 15 or something like that, and I guess the implied valuation in the take private is roughly, I guess, 300 million US, or maybe a bit less, something like this. I guess it turns out to between a quarter.
I have too many numbers swimming in my head right now to comment on that. I don't have a spreadsheet in front of me, but yeah, I think you're about right. There's 30.
And Altius's enterprise value, if you just remind me here, it's like just over $1 billion, or just $1 billion US, I think, is sitting at, or is that right?
Somewhere in that range, yeah.
Yeah, so it's.
I think some of that. Obviously there was a daylighting of value in ARR through that take private transaction. Just it was straightforward. We own this many shares of ARR. We're trading at say $9 forever, and then all of a sudden there's sophisticated buyers trading at 12 or bringing it at 12. But I think a lot of the feedback I've had from mineral shareholders is that I think they're quite drawn to the fact that the problem around where is it going to access enough capital to really meet its full potential has kind of been answered. So there's some of that's built in. And a lot of the other investor question I've been getting lately is almost what you started with, or you took me through a little bit earlier. People are doing that math around Orogen and trying to net out what the other things are worth. They're saying like, what's going on here? Because you guys seem like you're laggards, and so some of that movement in our share price, I think it's the combination of those things. It's in a weird way, I suppose. In some ways, we're being we're being wagged a little bit by Orogen as the dog. We're the tail being wagged there, even though we have the bigger royalty piece. But obviously, just the visibility through Orogen. I think a lot of the investors who are looking at Orogen have seen an arbitrage opportunity, that there was something being missed in the market in minerals based on whatever conviction they had around the valuation of silicon within Orogen. Well, yes. For whatever that's worth, that will be the investor feedback I'm getting. If you're wondering what's been happening with our market, but that seems to be the common themes. I keep getting questions and conversations happening around.
And I think, all of the value is revealed in due time, so long as you make competent decisions with the assets, which you have a track record of certainly doing. So I think it's just a matter of timing, and if you start doing these exercises where you take the puzzle pieces and start to putting a reasonable value, you'll quite quickly come to the same conclusion as Brian has, that the existing portfolio is cheap. That's why you're buying back shares consistently.
I've said it here before. The main part of our job is to not screw it up.
Exactly. So if we just cover the kind of the last little segment here, financial position and access to funding, can you just remind everyone what that looks like currently, and then maybe you can pivot over to speaking about the market outlook in terms of potentially making new acquisitions, and then maybe we can talk about how that competes to buying your existing portfolio, and just do that segment again.
So first part of the question was around access to capital.
Access to capital, current financials.
Yeah, so we've been building up cash for most of the year. Some of that was because while we were working on minerals, was aware that the Altius Renewables transaction was underway, and that put it on blackout, so we weren't piling every dollar into the buyback as we had been months before. So cash is built up well there. Ben has been doing really good work on we're coming up to refinance time on our debt. He's been doing good work there. We don't feel constrained, to be honest with you. I mean, if there's an opportunity that's something that came along tomorrow that we needed capital for, I feel like we could tap various resources and get whatever we needed. You had to remind me the second part of your question.
Just how it relates to your view on the market currently. We spent some time discussing. I think it's always interesting to hear guys like you that see a lot to give your comments about what you think the status is in the market.
Yeah, like it's obviously some of the key commodities we all follow are tracking pretty nicely, up and to the right here. Gold most notably, but even copper's been wild and volatile trade. But if you pop that chart up and look at it on 10 or 15 years, like it's doing its thing. We're definitely still below incentive there, but there's that's not an undertold story anymore in a lot of ways. I think a lot of people are just timing and trading around it, but there's I think everyone gets it that there's a crisis coming unless a price is put into the market that gets production built. And it remains, and it has for quite some time, a when and not an if. But it's probably going to be explosive when it actually kicks. Potash, again, I think from its highs, it's probably overcorrected here a little bit. Something like lithium, kind of pretty intriguing right here. This is the kind of levels that get my contrarian spidey senses tingling a little bit here. It feels like it's a bit overdone, but it was necessary. Like it's just a reaction to an overreaction to the upside, and in fact that upside, the pricing that we saw wasn't healthy in the long haul because a bunch of crap got built, and that's contributed to oversupply, and now the market is doing its thing. The secret is, after the carnage, what's left standing. So these can be interesting times. And it's neat that not everything is running in total sync with each other right now. There's some things that are on cycle and off cycle because it lets us not get bored too much. Is always something to look at. As far as the opportunity set goes, it's not good enough that much is coming to market looking for, like, say, project finance. Like the other pieces there, it feels like it's close, and you're in that M&A phase right now, but they're just sponsors coming out and saying, we're going to go raise equity, raise debt, and put a royalty on a project and go ahead and start construction. Not seeing a ton of that at the moment. Not seeing a lot of existing portfolio assets come into the market. There's been enough of that done. I don't know how much there is even left to come into the market. Sort of things that were aggregated a little while ago. So I guess I often am at odds with a lot of peers in the royalty space who seems like every quarter talk about, well, we have piles of deals on the go and loads of deal flow. Maybe it's just because we killed so many of them in the first 5 minutes that it never feels like we have that many. But yeah, it's not. I wouldn't call it particularly active out there right now. Yeah, but it's not a horrible time. It's not a spectacular time. It's kind of in the middle there, and you just let the things we have mature, and those operators invest in those assets. I know there's a lot of work going on in groups around what do we have that that has brownfield economics. Like anyone who has that is really busy on it. Lots of people are busy working and looking at M&A opportunities, and there's no shortage of bankers trying to beat that drum and get that going, of course. Some seem like they're inclined, others are just not going to go there, and they're even looking at greenfields opportunities. But M&A brownfields type announcements. That's where we're to right now.
Yeah. So I mean, snapshot picture in time, buybacks is going to be the main tool to deploy capital. It sounds like that's fair to say in the coming year, most likely, if nothing changes. Or cash building.
Well, you never know, right? Sometimes these opportunities come overnight, so you just never know. But yeah, as far as something just readily attractive, even there though, I mean, we're opportunistic. We can be patient, but yeah, definitely, we're expect to be active there. I definitely do see going forward after the ARR transaction closes that Minerals is not going to want, it's going to want to contribute and at least partially pro rata or hit its contributions on a pro rata basis. That growth trajectory, that window is very open. These tough conditions that are driving us to take the company private are being experienced by all of the developers and builders. Right? They don't have access to attractively priced capital either. So, I mean, in other words, the equities and debt markets that we compete with are hurting. And just to give you a comparison, I mean, it still feels like, I don't know how long this window stays open, but it's open right now. It feels a lot like mining did in that 2015, 2016 period, right? If you were a royalty, you had capital as a royalty player, you had a far more active opportunity than when you were competing with the other markets. Like when you're the only source of capital that's left standing, that's a pretty fun place to be. And if you don't hit those windows, there's something very wrong with your mindset about building royalty companies, in my mind.
Yeah. So building cash mixed with being tactical with the share buybacks and obviously always looking and always proactive if a new asset is more competitive than buying the existing assets. That's the stance still. So it's
We're quite content to let things play from here. We're also at the ready for any opportunities that come along, whether it's through the buyback or if it's something external, we're definitely more active again on the PG side, I think. We kind of cleaned out the system a little bit earlier in the year when we're raising capital to fund more purchases on the buybacks. I know Lawrence and Chad have been very busy looking at earlier stage projects and thinking, about the longer term opportunity set, either from building our own projects, investing in some of the juniors that we think have great projects through equity and royalty. So that's busy again right now. It feels like time to fill the cupboards there again. Yeah, there's always something to do.